Hello, everybody. Welcome to another edition of Connected Insights. We're here with Cody Daniels today. He is an expert CPA in the construction industry. So we'll look a little bit at the intersection of tax policy and business strategy. Obviously, the one big beautiful bill just came out. We know there's been questions, and I don't think there's any better person for someone to answer those questions in the industry than Cody. So I'm Brian Zielinski. I'm your host, co-founder of Shape Connect, CEO. We are privy to some great experts, software service providers from our business solution matching platform. Cody has been with us now for several months. We work quite a bit in the construction space, a lot of technology selection for construction owners, but then marrying, the technology with a great accounting partner, the results are always outstanding when those two things come together. And now this layer of tax policy and understanding the implications of it. So with that, I'll give Cody the floor, let you kind of introduce yourself and take it away.
Sure. Well, thanks, Brian. Thanks for having me on. I know taxes are not always the most riveting subject matter, but super important, especially given the recent passage of the One Big Beautiful Bill Act. So I'm very excited for the opportunity to sit down and dive into it with you. But yeah, I guess a little bit about myself. Founded my firm Builders Tax Group in 2024 after 12 years at a top 150 CPA firm. While I was at that old firm, I led their construction and real estate tax team as well as their cost segregation practice. And back in 2024, I decided I wanted to take the dive into entrepreneurship. So started up Builders Tax Group as a boutique or niche or specialized, whatever kind of term you want to assign to it, CPA firm focused on working with construction and trades businesses, helping them out with tax planning preparation, outsourced accounting, fractional CFO services, as well as cost segregation services to anybody that might own real estate that they use within their business or rent out.
Excellent. Yeah. So you ran the gamut. It sounds like everything construction and just understanding, how to manage your financials as best as possible. So one big beautiful bill. I mean, there's a lot of components here. I think we're looking at, we have depreciation opportunities. You've got, domestic R&D. I think that came back on the table. What's going on with the green energy incentives, financing. So thinking about all these things collectively, I guess maybe a good jumping off point might be, you've got this reinstatement of the 100% bonus depreciation now. What changes would you recommend to construction firms in terms of purchasing equipment, vehicles, buildings, things of that nature with this new reinstatement?
Yeah, so depreciation has always been, I think, kind of a core principle of tax planning for construction businesses because it's so fixed asset intensive, whether it's, equipment, tools, vehicles, leasehold improvements, buildings, all those things that you mentioned, Brian. What is now, I think, factoring into our decision making is that we have 100% bonus depreciation back on the table. Prior to the One Big Beautiful Bill Act, we were down to 40% bonus depreciation. So what that means is when you purchase equipment, vehicles, etc., in virtually all cases, there are some limitations. You're going to be able to write off 100% of the purchase price of that asset in the year that you place it in service. And then with the additional opportunities provided via increased expensing via 179, really there shouldn't be any, again, with rare exceptions, any capital expenditure that's not being written off in the year of purchase. So a lot of opportunities there to make purchases before the end of the year, reduce your tax liability. I would say that my advice is always to approach this from a business and economics perspective first before thinking about tax law. I don't think we should spend money just for tax benefits. You got to have a need for that equipment. You got to have a need for that next truck or that next van. Like if there's no business need for it, I wouldn't recommend making the purchase. But if you're growing, if you need that, that new truck, that new piece of equipment, you're going to use it out in the field. there's plenty of opportunity here to look at this before the end of the year and make purchasing decisions.
Yeah, unquestionably. I know another component of that was there's kind of a manufacturing construction opportunity now that I think you have 100% deduction for newly constructed manufacturing facilities. How do you see this impacting your construction clients? I mean, you have, in terms of the bidding on manufacturing sector projects, or in terms of maybe investing in their own production capabilities.
Yeah, I think this is a really interesting part of the new tax bill, and something that is, I think, going to have multiple ways of impacting the construction industry. I think there's the obvious expectation that because of this benefit, and maybe to step back just a sec to clarify, kind of what this benefit is it's for newly constructed commercial property that's using like a manufacturing, production or refining capacity. So it's a bill or part of a bill that's designed to incentivize building out manufacturing here within the United States. So without this bill, any newly constructed commercial property will be depreciated over 39 years, without the consideration of a cost segregation study. We talked about cost seg at the top of the show, and ignoring cost segregation study, which would allow you to depreciate components of the building over a shorter time frame. It would take 39 years to recover the cost of this investment. Well, now with this new provision in the bill, any manufacturing facilities that are constructed between January 19, 2025 and December 31, 2028, you can write that off entirely in the year that the construction is completed. So I think number one, we're going to see a big push in investment in manufacturing facilities, which is going to help contractors that might be bidding on those jobs. But I think there's a secondary benefit available here, where if you're a contractor that has a manufacturing aspect to their business, you may be able to benefit from your own investment into a new facility. So I think, a good example may be you're a general contractor, you're doing like kitchen and bath type work. What if you have a component of your business that is doing custom cabinetry that you then use in your like kitchen and bath build outs? Well, if you invest in like a new facility to construct that custom cabinetry, that would fall under a manufacturing definition. At least we think, based on the initial passage of the bill. We probably need more definition or what qualifies there. But my initial take on it is something like that would qualify. So if you build out a new shop space, you could write off that entire shop space in year one. I think there's a ton of examples within construction where you may have a manufacturing element to it. Electrical companies that are potentially manufacturing fixtures within their building, HVAC companies that may be doing some sheet metal fabrication. All of those things we think would fit under the definition of manufacturing and potentially allow you to benefit from this provision within your own business.
Yeah, no, that's a lot of different angles you can come at it on that front. I know, kind of in the same realm a little bit, you've got now the green incentives, and there's some interesting timing on that front. So some of these deductions and credits will now expire in 25 or I think into 26.
Right.
How are you kind of advising your clients on, scheduling these projects and ensuring these benefits, you can maximize them before they go away?
Right. So the first email that I sent out to my clients and everybody on my email list when the One Big Beautiful Bill was passed was, don't panic. Most of the provisions within this bill are going to affect your 2025 tax return. So we have time before the end of the year before we need to really start worrying about implementation. Let's just all take a deep breath and, approach this methodically and intentionally, with a few exceptions. If you're somebody that is interested in acquiring an electric vehicle and you want to get the benefits of the credits associated with the purchase of a new electric vehicle, that is incredibly time sensitive. The credits associated with that terminate on September 30th, 2025. So we really have just a few weeks if you're looking to make that purchase to get out to the dealership and complete that acquisition. Another pretty time sensitive area of the new tax bill is energy efficient home improvements and the credits that are associated with placing in service energy efficient appliances and things like that. So if you're gonna put in a new furnace, AC unit, if you're somebody that's looking at maybe doing like some solar panels on your house, those credits terminate after December 31, 2025. So we have a few months there, but still something that if you're looking to take advantage of those credits, you really need to get going on here quickly. And I think that'll be interesting if you're a mechanical contractor or you're an electrical contractor that is doing solar installations. Maybe you do see a bit of an uptick in business here to close out 2025. I could definitely see consumers, hey, we need to get that new furnace in. We've been thinking about it, debating for the last year or two. But now that we're going to potentially lose out on that credit, we want to get that furnace installed before the end of the year so we can, maximize our tax savings associated with that. So I think you could see a little bit of an uptick in business if you're operating in that space.
Yeah. Now, if we think a little bit more as we shift over to the residential front a little bit, I guess there's some new opportunities in terms of revenue recognition. And with the expansion of, I think it's the completed contract method for larger residential projects, are you recommending specific strategies to improve the cash flows for contractors on this front, manage taxable income? That does seem like another emerging opportunity here.
Yeah, totally. And before we dive into this, I will say this is probably the most technically complicated part of the tax bill that we're going to discuss. I think the accounting methods available to contractors are some of the most complicated areas of tax law that we have in this country. So bear with me while we go through this. But if we take a look at the previous tax law, there are requirements for contractors to reflect their revenue in a lot of cases using the percentage of completion method. So if you're a large contractor, which at this point in time means your average annual gross receipts exceeds 31 million, in a lot of cases you're going to have to utilize the percentage of completion method of accounting. If you're a small contractor below that $31 million threshold, you may still be required to use percentage of completion accounting for alternative minimum tax purposes, which in very simple terms is just like a separate tax calculation that applies to individual taxpayers. So if your business is structured as a partnership, S corporation, sole proprietorship, you would be potentially subject to this secondary tax calculation and would be required to report your jobs under percentage of completion for those purposes. Percentage of completion basically requires that you're recognizing revenue as you're inferring expenses on the job throughout the life of the job. So if at the end of the tax year, you've incurred 25% of your expenses that you expect to incur on the job, you're going to have to recognize 25% of the revenue. So we're matching revenue and expenses. Logically, it makes sense, but from a tax perspective, it's not necessarily advantageous because you may have incurred the cost and now you have to recognize the revenue. But what if you have collected, on the billings or the receivables associated with that job? Now you're paying tax on something that you don't actually have the cash to pay. So it's a logical way of accounting for things, but it's not an advantageous method from a tax perspective. So there are exceptions within the tax law that allow you to use methods other than the percentage of completion method. And if we go back to 1986, when like this initial sort of percentage of completion method law was put into place, there was an exception specifically for home builders. So if you were building homes, I guess back in the 80s, you must have had a good lobbyist that helped get this exception put into place for you, where you could utilize other methods other than percentage of completion. One of those methods being the completed contract method of accounting, which allows you to defer all of the gross profit on the job until the year that the job is completed. So you're not paying any tax until that job is completed. That was only available if you were basically doing like single family homes, duplexes, small, single family type residences, things like that. Now, the One Big Beautiful Bill Act expands that exception to all residential contracts. So that would include multifamily buildings, it would include condo buildings, assisted living facilities, college dorms. One of my favorites, prisons are considered a residential contract. Kind of strange, but that's how it's defined in the tax code. So what this is doing is it's expanding the jobs that you can utilize this other method of accounting for and potentially allow significant deferrals on the job. So to give an example here, because I know it's a very complicated area, I worked with a home builder a couple years ago that got into doing multifamily buildings, large apartment buildings, 50, 60, 70 unit buildings. We had to recognize the income on those jobs using the percentage of completion method. So we're recognizing income throughout the tax year. And that income is going to fluctuate because our estimated costs are constantly changing, especially, they were doing this kind of peak COVID, materials costs exploded out of nowhere. They're not able to pass it on to the end consumer, and their profitability is fading over the course of this job that's taking them multiple years to complete. So all the while they're paying tax, and when we get to the completion of the job, there's really not that much profit left to speak of. So if we had this provision available to them, they would have been able to defer all of the profit on the job to the year that they completed it and not pay any tax until that job is done. So yeah, I think this is a great provision, really impactful for anybody that's working on residential contracts, again, multifamily, assisted living, dorms, etc., to take and kick the tax can down the road for several years on these jobs, so to speak, and really, to your point, Brian, preserve the cash flow throughout the life of the job, pay the tax at the end of the job when you know what your profitability is going to be, and really just smooth out the cash flow overall.
Sure. Yeah. Yeah. And if you can make that an advantage. And then, the other opportunity potential here is also on financing and debt strategy. You have the business interest deduction limit is now based on EBITDA instead of EBIT. So how are you changing the financing conversations now with your construction clients? Are you, especially as it relates to the large projects and equipment loans that they can go after?
Yeah, I think, it makes the conversation of taking on additional debt a little bit easier. It makes that decision-making process a little bit easier, knowing that you're less likely to run into an interest expense limitation. So, and break it down. It's exactly what you were saying, Brian, that prior to the One Big Beautiful Bill Act, your interest expense was limited to 30% of your tax EBIT. So that's earnings before interest and taxes. Now it's 30% of your tax EBITDA, meaning that the deductions for depreciation and amortization are not factored into this calculation. You effectively need to add those expenses back into the calculation. So again, construction being a very fixed asset intensive business, and with things, like 100% bonus depreciation and all these other opportunities to write off our CapEx, we were seeing a lot of contractors where, they're not able to deduct their interest expense in a given year. It gets disallowed and carried forward. Well, now I think there's much greater opportunity to get the full benefit of the interest expense deduction. And it just, I think, overall makes that decision to take on additional debt a little bit easier, knowing that things are not going to get hung up. You don't have to balance like, okay, what should my depreciation expense be? Should I be electing out of bonus depreciation because I don't want my interest expense to get disallowed? Now I think it just kind of streamlines and simplifies the whole process.
Sure. Yeah. No, it could be a bit of catalyst for growth.
Yeah.
Being able to grab some of that opportunity. The other, opportunity for maybe growth or additional projects is, the workforce retention and overtime. So, overtime pay, is now tax-free for workers, between 2025 and 2028. What's the effect you think this will have on staffing and then project timelines for clients?
Yeah, I think we look at all the provisions in this tax bill, and they're all designed to encourage some form of activity, right? If we go back to, sort of the depreciation provisions, it's designed to encourage investment in new real estate, equipment, vehicles, et cetera. We want businesses spending money. Well, I think this provision is, to encourage people to work in fields where overtime is an option, and to encourage the people that are working in those fields to maybe pursue overtime that they wouldn't otherwise pursue, knowing that they're not going to be taxed on at least a portion of those dollars. I maybe should clarify that there are some limits in play here. It's not all overtime. It's up to a certain dollar amount every year. So if you're somebody that's really highly compensated, working a ton of overtime, it may not be every dollar of overtime. There may be income limits that apply. So again, if you're highly compensated, or maybe even your spouse is highly compensated, you can start to experience some reduction in the amount of overtime that's tax-free. But I think overall, it should encourage more incentive for people to move into these positions where they could be, earning tax-free dollars. And again, if you're already in that position, if the overtime is voluntary, maybe you're raising your hand instead of, going home on the weekend, because you know that you're putting 30% more in your pocket than you would have if this law wasn't in place. So yeah, I think it'll be really interesting to see how this plays out, and how it, hopefully encourages some, additional labor force to enter into the trades.
That would be huge. I mean, we're members of the ASA in Chicago here, and I mean, we send out a benchmarking survey every single year, and I think the last couple of years, I mean, labor shortages have been the number one that subcontractors are facing.
Yeah.
And so, right, if this can make an impact, I mean, I think that's kind of a win-win across the board. Get people paid more, and then that's a magnet to the field.
Yeah.
So we'll have to kind of keep an eye on how that'll out. Another opportunity, right? It's been the two things, actually, going back to that benchmarking survey we did with the Subcontractor Association. It was labor, and then it's also, efficiencies and innovate. I mean, a lot of companies are looking to garner more efficiency in their business. And maybe now the R&D tax credit coming back into the fold. I mean, can that have an impact on efficiency? Meaning, how are you looking at, your contractors, your customers in that realm? And, are you guiding them on developing new construction methods, looking at energy efficient technologies? Are they able to use this credit for investments like software, like ERP and things of that nature, to kind of up-level their operations?
Yeah. So, yeah, great question, Brian. I think that the R&D credit available for tax purposes is frequently overlooked within the construction industry. I think people think, well, you got to be like a pharmaceutical company or a tech company, or, you got to be inventing new medical devices and things like that to take advantage of an R&D credit. And that's just not true. Credits are available for things like, developing new construction techniques, utilizing new materials, implementing different processes to increase job site efficiency, creating custom solutions for complex problems, using new technology, using, green, building techniques and energy efficiency and things like that. So if you're a contractor that is really working through any process of experimentation where the outcome is uncertain, there may be an opportunity to claim an R&D credit study here. It doesn't have to be, the invention of some new product or the development of some new software that's going to go out and hit the marketplace. It can be, very business specific things, your internal processes, materials that you're using, utilizing new technologies, all things like that could qualify. If you're a design build contractor and you have engineers on staff, and they're doing things like BIM and other kind of new building techniques, like those are areas where there may be opportunities to claim this credit. And the credit is significantly more beneficial now under the provisions of the One Big Beautiful Bill Act than it was previously, because previously we had a requirement to capitalize those research and development expenses that we were incurring. So you can imagine, okay, you got salaries to your engineers and your employees that are working on these R&D credit activities. You may have expenditures for materials and things like that associated with the research activities and the testing and all of that. Sure, you would generate a credit on that, but you'd have to capitalize and amortize those costs over 5 years. So you're not getting the benefit of the cash out the door associated with that. Well, now that capitalization requirement has been removed. So you're going to not only get the benefit of the deduction associated with the salaries and wages and things like that, but you're also going to get the credit on top of it. And credits are hugely beneficial. When we think about deduction versus credit, your depreciation deduction is beneficial to the extent of your tax rate. So if you spend 100 grand on new equipment, you get a depreciation deduction for that 100 grand. The tax benefit to you is, depending on your rates, maybe $25,000 to $40,000 of tax benefit because it's at your tax rate. Well, credits are dollar for dollar. So if you generate $100,000 R&D credit, that's $100,000 of tax savings. It is a dollar for dollar benefit to you, money in your pocket. So credits are huge, and like I said, this is very overlooked area for contractors. So if you have like any inclination that you may qualify, like, I think it's worth having a conversation. These credits, I will say, they're things that most CPAs aren't going to necessarily offer themselves. They're going to work with an outside firm to come in and help you vet the viability, probably provide you with some sort of indication of how much credit you may be able to achieve, and then move forward with like a study that's going to require you to provide them with, again, like payroll data and other, things like that to determine it. So there's a bit of a process, but it's worth having that conversation if you think you may have some activities that qualify.
We've had more inquiries from companies around AI
Yeah.
utilization, implementation within the business. Many of the workflows inside these companies do require some customization to AI. Obviously, for it to work, there's some out of the box opportunities that's baked into, software platforms that companies frequently use in the construction space. But do you think that, companies that are leaning into AI and building custom agents, and working with, maybe it's an outside partner, that's an area we've gotten into heavily, that's a opportunity to utilize the credits, the R&D credits?
That's a really good question, Brian. I will say it's probably so new that it hasn't really been contemplated by anybody at the IRS or anybody that would potentially challenge the viability of a credit claimed associated with that. So I think it would definitely be worth having a conversation around. I think I can see a path where there is an opportunity to claim a credit associated with, implementation of AI and implementing new processes internally and things like that. I could also potentially see that being challenged by the IRS, but I think it's so new to the game that we wouldn't necessarily know. And yeah, I would defer to the R&D experts. I have a few different firms that I have relationships with. If one of my clients were to approach me and say, "Hey, I wanted to pursue this," I would definitely bring in the experts and we'd have a conversation around it, and we'd lay out the potential risks. But I think, I think there'd definitely be some opportunities there for sure.
It's an interesting topic because AI allows for a lot more. It's a customized approach, and
Yeah.
consider that against. And we're seeing more companies go that direction against versus necessarily a software tool. More
Yeah.
companies seems like they will be building customized AI capability to take over workflows, and so it does, I think, bring a level of opportunity for R&D. That's a function of R&D potentially. So yeah, we
Yeah,
will. We
totally.
do have a partner that looks at those type of things. That we can. If customers have any issues, that we can maybe tell somebody that focuses exclusively on R&D tax credit.
Yeah.
Um, Another, I would say, emerging trend, and I think it goes into the bill here. The one big beautiful bill is ownership and succession planning. So multiple companies that we have worked with who are getting their technical aspects of their business in order, right? Up-leveling their information flow, their data, implementing ERPs and things like that. They're often doing it with the horizon of an exit and, kind of getting that business ready for that day. With all that, I mean, you have the qualified business income deduction. It's now permanent. So how does that factor into the advice you're giving in terms of ownership structure, tax planning, and succession strategies for your construction clients?
Yeah, definitely something that I recommend, business owners look at periodically is how is your business structured? And just because you picked a given structure when you started out doesn't mean this isn't something we should be revisiting at least every couple of years or so, depending on, where you're at with your business and what your kind of ultimate goals are. But yeah, the qualified business income deduction, for anybody that's not familiar with it, is a 20% deduction of business income from like flow through type businesses. So partnerships, S corporations, even sole proprietorships, like a Schedule C type business. Um, and you're able to exclude 20% of your business income from your income tax calculation on your individual return. What this effectively does is it effectively reduces your top ordinary tax rate from 37% to 29.6% on the flow through business income. And the reason this deduction was made available is because in the original Tax Cuts and Jobs Act, they gave C corporations a tax cut down to a flat 21% tax rate. And all the small businesses out there that are not organized as C corporations said, hey, what about us? Like, what benefit are we getting in this 20% QBI deduction? Section 199A is another term that people might be familiar with. They implemented that as like a benefit available to smaller businesses organized as, again, like a sole proprietorship, partnership, S corporation type thing. So I think it's a worthwhile exercise to evaluate your structure every couple of years and say, well, like, yeah, are we maximizing our benefits? When the 21% C corporate became effective, I had a lot of clients calling up and saying, like, well, should we convert to C corp? Should we convert to C corp? And it's like, well, not necessarily, because you have the 20% deduction available here. That's effectively reducing your top tax rate. The C corp comes with downsides. You have double taxation on dividends that you're paying out to yourself that you need to consider. In a variety of states, when you start to really kind of look at your overall tax picture, C corporations are taxed more heavily at the state level. In a lot of states, there are states where they may not have an individual income tax rate at all, but they may still tax businesses. So, trying to think through, the implications there, in a lot of cases, it still makes sense to be organized as this partnership, S corporation, something other than a C corporation. So, I think that's a worthwhile exercise to go through. I think as it kind of relates to succession planning and all of that, if you're somebody structured as a C corporation, that double tax is really going to hurt you upon the sale of your business. And the reason is because most business sales are going to be structured as an asset acquisition. The person acquiring your business is going to want to acquire the assets of your business and not the stock in your business. And the reasons that they would want to do that are because we have things like 100% bonus depreciation. They're going to be able to write off all the equipment. They're going to be able to take advantage and start to recover their cost of investment right away versus a stock purchase. Well, the basis gets trapped in the stock. They don't benefit from that until they turn around and sell the business. So ultimately, those dollars, if you're structured as a C corporation, those dollars are going to be trapped in the corporation upon sale. And the only way for you to get them out is through a dividend, and you're going to get hit with this double taxation. So if you're someone that's contemplating a sale in the next few years, we may have opportunities to move you into an S corporation structure in advance of that to eliminate the risk of this double taxation. It's something you're going to want to get in front of, because if you sell the year after your S election, there's a concept of built-in gains tax where they continue to apply that double taxation for a period of years. But if we know well enough in advance, we can make that election well before the date of sale. We can cap the amount of sale price that's subject to the double taxation so that any further appreciation is not subject to that. And these things are really start to add up when you're thinking about the sale of a business. I did this analysis for a client a few years ago, and what they projected their potential sales price could be, this conversion away from C Corp was going to save them millions of dollars. So we're talking multiple millions of dollars upon the sale of their business. So it's definitely something where the savings can really, really be significant, and it's something you need to be in front of. You can't make this decision months before a sale. You need to be thinking about this years before a potential sale.
Yeah. Other areas of deduction I know in this bill center around the project start timing and expire. There's also deductions expiring here. So I think the 179D and the 45L are set to expire for projects starting around mid 2026. Are you seeing clients adjust the timing of their the project starts to try to lock in these benefits?
Yeah, definitely. I think if you're somebody that could benefit from, from these deductions or credits, you should definitely be looking to get those jobs started as soon as you can. So the 179D is essentially it's a deduction for energy efficient installation of interior lighting systems, HVAC systems, or building envelopes. And what's interesting is if you're a contractor that's doing these installations and you do it on a government or nonprofit building, you can basically request that that benefit gets passed on from the government or nonprofit building to you as the contractor. So if you're an electrical contractor and you install an energy efficient lighting system in a hospital, a nonprofit hospital, for example, the nonprofit hospital is not a taxpayer. So they can basically give this deduction over to you, and you get a free deduction out of it for being the contractor that did that installation. And it can be up to $5 a square foot. So it could be pretty meaningful dollars based on the size of the property. That benefit is terminating for any job that starts after June 30th, 2026. So kind of like the other green initiatives, the electric vehicle credit and the home energy credits and things like that. These other sort of energy efficiency type benefits are going away. You do have until next June. So if you're a contractor that, maybe working with government nonprofit buildings, you may want to try to get those jobs started ASAP, so that you can capture that, because obviously 1 day difference could get the difference in whether or not you're able to claim those benefits. On the residential side, they have a similar benefit, 45L, and that's for energy efficient, home construction. It's up to $5,000 per dwelling unit. So if you're doing single family homes, you can get a credit of up to $5,000 per home. And it has the same cutoff date of June 30, 2026. So again, if you're a home builder in that space, you may want to get rolling on those jobs sooner than later if that's a benefit you're interested in claiming.
That's and then I would say one of the last big questions we've seen, and it's, I don't think it's always top of mind, is the opportunity zone incentives have been renewed. It looks like they've been enhanced. Are you encouraging construction clients to explore new markets or redevelopment projects that may not have been financially attractive before?
Yeah, so this is another area where, again, I think it's kind of multifaceted in how it's going to benefit the construction industry. I mean, there's because the opportunity zones have been renewed and we'll be seeing new opportunity zones designated prior to 2027. We would expect to see, again, similar to the manufacturing sector, we'd expect to see additional investment into these sort of economically distressed communities that are designated as opportunity zones. So I think we're going to see, number one, just an economic boost as far as investment is concerned, and that's going to benefit contractors. But if you're a contractor that also dabbles in real estate investment and development, property ownership on your own, there's some pretty significant opportunities here as well. There's, number one, an opportunity to if you sell another capital asset and use those funds to invest in an opportunity zone, you can defer the gain associated with that sale of property A, we'll call it. So if you sell property A and you take the funds from the sale of property A, invest it into an opportunity zone, we'll say property B, there's an opportunity to potentially defer the gain on that for up to 5 years. So kind of like a mini 1031 or like a mini like-kind exchange opportunity there as far as gain deferral is concerned. And then there is, if you're able to hold on to those properties, an opportunity to like potentially reduce or eliminate the gain on the sale associated with property B. So if you're able to hold on to it for 5 years, you'll receive a step up in basis equal to 10%. So that's just like a free 10% that's excluded from the gain calculation. And there's actually a provision here that says if you can hold the investment for 10 years, the fair market value of such investment when sold or exchanged, the basis in investment property is the fair market value of such investment when sold or exchanged. So potentially, if you hold the property long enough, you will get a step up in basis equal to your sales price. That means there's no taxable gain on the sale of that property several years down the road. So I'll say it's a pretty complicated, nuanced area. You're going to want to work with somebody that's an expert in qualified opportunity funds and qualified opportunity zones. So this is not something every CPA is going to be well versed in, but again, the potential for tax savings is huge.
No doubt. Yeah, I know some people in the industry that were, I think, working on it. The last time it came about in 17-ish. And yeah, so overall, I mean, I think we went through the 10 main questions that we've kind of heard from customers, in particular, what you've laid out in your, from your conversations. Was there anything we missed? Is there any other key facets that you want to address
Yeah, a little bit of a
on the one that you?
loaded question there, Brian. I mean, yeah, there's a ton that we didn't touch on. I think what we did cover is from a business perspective, what is most impactful to the construction industry, right? I think these are the things that if you're running a construction business, like you need to be aware of these, you need to be considering these opportunities. But yeah, there's a lot beyond this. There's a ton of individual tax provisions, a lot of things where they locked in existing law as permanent. So avoiding tax rate increases, they locked in the old kind of reduced rates. Increased deductions out there, for state and local taxes, potentially car loan interest. And there's some changes to charitable contributions. So there's a lot out there. I don't think we necessarily need to dive into all of it today. It's too much for anybody to digest at once. But yeah, it's just it's the second massive tax bill that we've had in less than 10 years, and I just think it's critical for entrepreneurs, business owners to be aware of these things, to make sure they're working with professionals that are staying on top of the law changes and we're doing strategic planning around these things. So yeah, I mean, I guess kind of final piece of advice is just, I don't expect anybody out there watching or listening to learn everything in detail. You're going to do your own tax return because of this, but you just want to be aware and be able to have informed conversations with your advisor and take advantage of everything that's available to you. These bills are passed for a reason, and it just due to the virtue of our tax system being something that's self-assessed and self-prepared. It's on you as the business owner and on you as the professional that you're working with to make sure you're taking advantage of every opportunity that's available to you.
Well, I know we appreciate it, and we, that's our goal at Shape Connect. I mean, obviously, you want to make sure that the providers like you, the experts like you, we're getting these insights, especially when something significant occurs. It's in this fraud tax and everything. I mean, that one big beautiful bill is a significant event for all business owners and other areas, right? We've had to look at from a technology perspective, what's AI mean for companies, and bring to bear experts to have a conversation around that. So we'll be here to continue to showcase individuals that can help. Anybody has questions for Cody, we'll make sure that you have his information. We have a kind of accounting financial assessment within the Shape Connect platform. And then, especially if you're in the construction space, we can get you, kind of have you run through that and then get you connected up with Cody to maybe dive deeper on any of these topics that we discussed today. So, Cody, thank you again for joining us, and we will see everybody on another edition of Connected Insights soon.
Thanks, Brian. This has been great.